The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome to Financial Planner. Well, as you remember, last week we were discussing about various products that are available in the secondary market. We touched upon mostly the equity related instruments, and now we are touching briefly on the debt related instruments, some which are completely for institutions, that is companies, to look at investing, and few which you as a retail investor also get a chance to be a part of in terms of the debt offerings of a particular company. And we have with us Jayant Pai to guide us through all that. Jayant, thank you so much for joining us. You know, last week we were discussing about rights issue, bonus shares, preference shares. The other part of the secondary side, secondary market products are more debt related, right?
Yeah.
So basically, as against when you become an equity holder or you become a part owner of the company, basically the company owns something to you. So I'm the creditor and the company is a debtor, right?
Yes.
So now when we talk about couple of instruments that are there, which is your security receipts, your treasury bills, your government securities, which are products which are generally sort of taken by the companies. Now let's go one by one. What are security receipts?
Just like you have a fixed deposit receipt when you place a deposit with the bank, security receipts are documents which are issued by either securitization companies or asset reconstruction companies, and they are issued mainly to institutional buyers, and they are merely an evidence that you own a certain asset which is given by them. So they are the originators of the asset, and the holders have this receipt, a security receipt known as evidence. Now these may be tradable or non-tradable, but in the basic thing is that it's just an evidence that you own a certain thing.
Okay, so basically, particular institution is suppose lending money to X company, which is, issuing security receipts, is basically an instrument that is shared between the two of them, tradable in stock exchange or may not be.
Yeah, or it could be tradable over the counter also.
Okay. Now as far as government securities, as the word describe, obviously issued by government, is that correct?
Yeah, it could either be the central government or the state governments. Securities issued by the central government are known as sovereign securities.
Okay.
And they are also known as dated securities, because
so these securities are not something that a retail investor can look into.
They are not prohibited from investing, but logistically it is very difficult.
Okay, and why so, if you could just...
One is the ticket size, that is the minimum size is usually 1 crore per bond or per government security, so that is out of reach for most of them. And secondly, individuals can take an exposure in these through mutual funds, because debt mutual funds invest in the same thing after aggregating the money received from several individual investors.
So essentially what you're saying is it's basically government is borrowing money from investors at a particular rate.
Yes.
And then gives that to them. And that rate generally is called the coupon rate.
Yeah, and that's usually paid half yearly.
Okay, alright. Coming back quickly to treasury bills. What are treasury bills? How is it different from security receipts and government securities?
Yeah, the first difference is in terms of the tenure. Because in treasury bills the maximum tenure is 364 days. So there are three types: 91 days, 182 days and 364 days. And these are issued only by the central government, not by state governments or any other government institution.
Okay. So basically the only difference between a government security and treasury bills are their time horizon or the period for which they are.
Yes, this is the main difference, yes.
Okay. Now coming back to something which we want to focus more on, which are your debentures, bonds and commercial paper. More we want to focus because that's something that our investors would be keen to understand, because that's where they can access these things, right?
Yes, yeah.
So let's go across first to debentures. What are debentures?
Debentures are debt instruments issued by companies. For instance, if a company requires long-term funds, or it may even be for working capital, but usually it is for longer term funds. So where they raise the money for around 18 months to 2 years or beyond. So again, debentures are merely evidence that you own a certain thing. And again, debentures may be classified into various different compartments. One is secured and unsecured. In secured, each debenture, that is each creditor, like when you purchase a debenture, you become a creditor of the company.
Yes.
So the money that you give is secured against a certain asset of the company.
Okay.
It may be plant and machinery or buildings or whatever. So there you have some semblance of protection against capital loss. So if the company goes belly up, you have a chance of recovering at least some part of your money. In unsecured, that's not the case. So there is nothing which, it is similar to a fixed deposit in a sense.
But in that case, even if it is not secured, the company is and will be forever liable to pay you back that money.
Yes,
right?
surely. Unless it is a convertible debenture.
Okay.
In case of convertible debentures, you are a creditor for some time, and then they are converted into equity shares at some point in the future.
Okay.
This may either be a compulsory conversion or an optional conversion.
So basically, debentures can be designed in different forms. It can be a pure debenture when you are the creditor of a company, which can be secured or unsecured, or it can be a debenture which can be converted into equity.
Yes.
So when an investor is looking at investing in a debenture, he has to read it carefully as whether their conversion is compulsory, whether he wants that conversion, or if it is a pure debenture. Is that correct?
Yeah, you got to exercise some care.
Okay. As far as bonds are concerned, how are they different from debentures?
Bonds are instruments which can be issued by entities other than companies. Companies too can issue them, but other than that, there are certain government institutions or financial institutions, even the RBI, it can issue a bond. Now this may either be on behalf of themselves or on behalf of the government in case of RBI, where it merely raises money on behalf. Difference between the two is purely technical in terms of stamp duty paid. So that is one thing which retail investors need not bother. And third main difference is that bonds are never convertible into equity. They are always redeemed after a fixed period.
What is a commercial paper?
Commercial paper is similar to a treasury bill for companies, where companies raise money for short periods, ranging from 15 days to a maximum of 1 year. And they are more in the nature of promissory notes, because it is never secured against anything.
Okay.
Because companies usually take this to fund their working capital requirements.
Okay.
So the company merely promises to pay the bearer or the holder this amount at the end of the period.
Is it similar to, say, corporate deposits, or is it different? And if it is, what is the difference?
Corporate deposits are also unsecured. Only thing, they can extend to periods beyond 1 year.
Okay.
And one more thing is, in commercial paper, there is a ruling that only companies rated BBB or above, only they can raise commercial paper.
Okay.
While in case of fixed deposits, even companies below BBB can theoretically raise it, although they may not find a market, but they are not prohibited from raising.
Just to understand, we've seen an era when lots of corporate deposits are being raised by different companies. If you were to advise an investor as to what he or she should take in terms of investing, because a portfolio should comprise of equity as well as debt categories.
Yeah.
In that sense, if one is looking at a corporate deposit that is being raised by a particular company, what are the key things that one should look before going ahead?
First of all, you should look at the credit rating. Generally, don't invest in companies rated below AA. That's one thing. Second is that since these are very illiquid instruments, I suggest you do not put more than 5 to 7% of your debt portfolio into this. Don't go only by high yields. And finally, do not invest in tenures, beyond say 15 months to 18 months, because here you are taking a call on the credit worthiness of the company. And if you take an exposure of too long a period, you could get hurt.
One quick question that I'd like to ask you is that when we're looking at, when a particular investor is looking at various options of debt, whether it's debenture, bonds, or your commercial paper, corporate deposits, etc., what are the reasons he should look in terms of using this route as far as the getting debt is concerned? Because when you're looking at your portfolio, you have something like your PPF, your NSE, which gives you, as it is, a source of getting into debt market through these things.
Yeah.
If an investor is looking directly to invest, which category of investor should look at it, or why should one go for this, if at all?
If you want some variety in your debt portfolio, then these are good options. But do not go overboard on any of these. Also, as compared to the government sponsored saving schemes, these are of far lower tenures, because you will have tenures ranging from say 6 months to around 2 years, which you will not get in a government savings instrument. No doubt government savings instruments are very safe, but also these instruments offer you more periodic income, like income at greater frequencies as compared to a PPF or an NSE also. So you look, these help to plug certain gaps in your debt portfolio. For instance, your desire for frequent income, and also the in terms of lower amounts locked in for lower periods, shorter periods.
All right. Well, on that note, Jayant, we'll take a short break, but won't go anywhere, as we'll be taking up your queries, addressing your portfolio-related queries when we come back.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome to Financial Planner. It's that time in the show when we take up your portfolio-related queries.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, Jayant, we have a query from Akhilesh Kishari from Varanasi. He's working in a pharma company. He's 34 years old and he's got a package of about 4 lakh rupees. His investment, he says, includes one PPF account, which he's invested about 70,000 rupees. He has a mutual fund SIP every month of about 8,000 rupees in an equity fund. He has LIC, basically an insurance policy for 2 lakh rupees. Another LIC policy for about 1 lakh rupees, a term insurance as well, a Mediclaim policy, and also he has a school fee that he pays for about 50,000 rupees in a year, and he has no other responsibility currently. What he wants to know is that whether he's having a right approach as far as his investment is concerned, and also that he wants to retire at the age of 50 years and want to get 2 crore rupees for the rest of his life. Excuse me. But the other thing he's saying is that he has his son who's 9 years old and he would require some money for his higher education. So clearly he wants to retire early, which most of us want to, and wants to take care of his child's future. What is your suggestion?
Again, based on what he has written, I am assuming that he wishes to accumulate 2 crores by the time he is 50 and not requiring an income of 2 crores each year, because for an income of 2 crores he'll have to have a corpus of 25 crores.
Yep.
So if you assume 8% return, so that seems unrealistic based on his current savings pattern. So I have assumed that he'll accumulate 2 crores at the end of when he's 50, and then he'll derive an income out of that.
Okay.
Second is that I have assumed that the LIC policies that he has, they will mature when he attains the age of 50.
Okay, yeah.
And also the 2 lakhs and 1 lakh that he has mentioned, I have assumed that is a life cover from the policies, and 80% of the premium that he pays every year is invested, and the balance goes towards mortality charges and the other expenses. So based on these things, in case it's an endowment policy, so he'll be earning a paltry sum on that. So I have assumed 6.5% per annum. So that should amount to 4 lakhs at the end of this period of 16 years. Second is his PPF of 70,000. In case he invests the same amount every year and he earns 8% per annum on that, he should accumulate 19 lakhs on this.
Okay.
And finally, on his equity SIPs, in case he invests 8,000 per month for 16 years and earns around 12% per annum, he should accumulate 46 lakhs.
Okay.
So the sum total of these three will amount to around 70 lakhs. So there will still be a shortfall of 1.3 crores.
That's true.
Now, to make up for this shortfall, by the time he wants to retire, that is 16 odd years, he'll have to invest around 22,500 per month in equity SIPs, because I feel that is the one where he has the best chance. And also, as time passes, the volatility of the equity funds will reduce. So in case we assume an return of 12% on this enhanced amount, then he should be able to attain this figure. Now, from whatever he has written, I am assuming that he'll have a surplus. 4 lakhs he earns and then he spends, and he also pays tax on it. So he'll have a surplus of around 1.4 lakhs after these fixed expenses. So as much as possible, he should try to invest from this amount. So that's all, and that too in a few diversified equity funds, no sector funds or thematics for him. A few names I can suggest are: one is Franklin Blue Chip, DSP Equity and Fidelity Equity. So that, and also I mean, to increase his chance of getting to 2 crores, he'll have to increase his savings percentage. As the income grows. Right now it's pretty decent, 27%. But you know, as he earns more, he should channelize more and more into this. So
well, Akhilesh, as you heard Jayant saying, you know, everybody wants to retire early. You've set a corpus for your retirement of 2 crore rupees, but you're falling short at for about 1.3 crores. And the advice that Jayant has given to you is that you need to, while you're saving a lot, you perhaps need to work harder and save some more. And once you save more, you will at least have to invest in equity funds. You're 34 years of age, still a long time to go. And in this long period of time, equity funds, you know, over a period of time have given good returns as per the, you know, history, what it says. And there is no guarantee, but from what we have, so the inferences that we have drawn over these years, the equity has given good returns, much higher returns than any other asset class for a long period of time, and therefore investing in an equity mutual fund is something that Jayant is advising by increasing a little more as far as your savings is concerned.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, on that note, we'll take a short break, but we'll be busting some terms in just a bit.
The Financial Planner, presented by the Bombay Stock Exchange.
Welcome back to Financial Planner. It's the Term Buster segment, and the term that we have picked up today is STT, or Securities Transaction Tax. Jayant, what does it mean?
okay, as the name denotes, it is a tax which is levied on each transaction you undertake on the stock exchange, whether it's a purchase or a sale. And this applies to both the markets, the cash and the derivatives market.
Okay.
The rates will vary based on which instrument you choose, and you know, there is a long list, but I won't get into that. But the advantage of this is that one, the government is able to you know, collect the tax at source, so for them it's a good thing. And for us, for every transaction on which we pay STT, we do not have to pay long-term capital gains tax on equities. And also a concessional short-term capital gains tax of 15% only is levied on such whenever we undertake such transactions.
Okay. Now, for example, I have bought particular shares today.
Okay.
So, STT is applicable to me?
Yes.
So, once the STT is applicable, suppose those shares that are there in my Demat account, I hold them for at least 1 year.
Okay.
And then I sell it after 1 year. So, my long-term capital gains tax is not applicable.
Provided you pay STT on the sale too.
Okay.
It's not just on one leg.
Okay. So what you mean to say is that even if they say that if you hold your shares for 1 year, then long-term capital gains tax is not applicable.
Yeah.
That will be the case if you, but in that case you will have to pay STT any which case. That's right?
Yes, we have to pay STT whenever we sell anything on the stock exchange.
Okay. So whether we sell or we buy, you have to pay STT. Now there was this whole debate about STT being there or not there. What is the current situation? Is that a discussion table on the discussion table right now? If you could give us a sense on that.
Yeah, actually there was a belief that STT may be scrapped in the earlier budget, and we will go back to the old regime. So
what was the old regime?
Wherein you pay long-term capital gains tax based on indexation. Even today, that same regime applies to debt securities, where you pay either 10% or 20%. You know, it's that regime is very much on for debt securities. For equities, it's not so. There was a fear that the same regime will apply to equities also, and also once the direct tax code comes in, there was a fear that such a thing may come. Now, in the initial draft, it was proposed that STT be scrapped and replaced with a rather convoluted system of taxation. But now, based on certain feedback that the FM has received, STT will remain. Only thing, there will be slight tweaking of the capital gains, the way in which it will be levied. Long term will still be zero. In short term, there is a slight change. So, I think STT should remain even when the DTC comes into effect.
So, irrespective of the time period that you're buying or selling, or the frequency of that, you have to pay STT for every transaction that you sort of take in the stock market.
Yeah.
What is the rate of STT?
It's 0.0125%
Okay.
for the cash market, and for derivatives it is 0.04 or That depends again whether it's futures or options.
Okay, okay. So essentially, for every transaction, it's a 0.0125.
It's a very minuscule figure, which does not affect us much. At the same time, it's administratively very easy for us because all such transactions are not within the ambit of long-term tax. So it really is helpful. So I think people should not mind paying it.
Well, on that note, Jayant, we've come to the end of the show. Thank you so much for joining us for this show. Well, that's all we have for this episode of Financial Planner, but we'll be back with more for our next episode. So keep watching this space.